Happy New Year, everybody. This is Money Mentor Brian. Today, we are looking back at 2024 through some key financial metrics and trends. 2024 was a great year for U.S. equities. Leading the pack, the NASDAQ Composite delivered a 32.3% return, driven by the strength in technology stocks. The S&P 500 wasn't far behind, posting an impressive 26.9% return. Meanwhile, Russell 2000 small caps gained 12.2% and emerging markets grew by 8.8%. Internationally, the MSCI EAFE managed a 5% return, reflecting slower growth overseas. On the flip side, bond investors had a tough year, with Bloomberg Global Ag Index down 1.8%. This is due to rising rates pressuring fixed income markets. Breaking down the S&P 500's performance, factor investing made waves. Momentum emerged as the standout factor with a 48.4% return, followed by growth at 38.6%. Quality and low volatility held well, with returns of 27.3% and 14.9%. Meanwhile, value and dividend investing lagged behind, returning 13.4% and 7.8%. In the S&P 500, 7 out of 11 sectors posted double-digit returns this year. Leading the charge was the communications sector with a stellar 36.6% return, bolstered by gains in Alphabet and Meta platforms. Financials followed closely at 31.7%, thanks to a strong rebound in bank earnings and fintech growth. Consumer discretionary took third place with 29.5%, driven by increased consumer spending and e-commerce growth. Technology and utilities also showed strength, delivering 24.2% and 23.9%. At the other hand, healthcare and materials lagged, returning just 3.5% for healthcare and 1.1% for materials, while real estate and energy barely eked out gains at 4.7% and 4.2%. Communications, tech, financials thrived on innovation and economic recovery, while defensive sectors like materials and healthcare faced macroeconomic and regulatory pressures. The IPO market made a significant comeback this year. U.S. IPO volume was up 35%, and proceeds surged by 53%, reaching $29.6 billion. We saw 146 IPOs in 2024, a big jump from the 108 IPOs in 2023, signaling a renewed appetite for public offerings after a challenging few years. Merger and acquisition activity also saw an uptick. Transaction value increased by 12% year over year, with 17,574 deals, totaling $1.9 trillion. This rebound reflects improved corporate confidence and strategic deal making despite a volatile macroeconomic event. U.S. household net worth climbed to an all-time high of $159 trillion by Q3 2024. This growth underscores rising asset prices and economic resilience amid inflationary pressure and higher interest rates. The upward trajectory in household net worth reflects wealth accumulation and financial recovery post-pandemic. On the retirement front, the average 401k balance grew steadily. According to Fidelity, balances for participants aged 55 to 59 reached $246,800, with those aged 65 to 69 averaging $252,800. Younger savers also showed encouraging progress as well, with balances rising across all age groups. Now, best and worst performers within the S&P. Looking at individual stocks, the best performers in the S&P 500 was Palantir Technology, ticker symbol PLTR, which soared an incredible 360% year-to-date, fueled by advancements in artificial intelligence. Vistra VST gained 266%, benefiting from strong demand in the energy sector, while Nvidia rose 176%, continuing its leadership in AI and semiconductor innovation. Green Energy Ventures, GEV, also had its IPO in March climb 154%, while United Airlines UAL rounded out the top 5 with a 141% increase, reflecting strong travel demand. On the flip side, within the S&P 50, Adobe was the worst performer, down 25.2% as competitive pressures and slowing growth weighed in on the stock. AMD fell 15.1%. Pepsi, Merck, and Johnson & Johnson all posted modest declines due to macroeconomic headwinds and industry-specific challenges. The winners were concentrated in high-growth, tech-driven industries and sectors benefiting from post-pandemic tailwinds, as well as artificial intelligence growth. Conversely, defensive nature and mature sectors struggled to gain traction amid higher interest rates and softening demand. Now, finally, this week, the market wrapped up some significant movements. The A-share ETF tracking Chinese equities is severely oversold, presenting a potential buying opportunity for contrarian bulls. On the other hand, energy ETFs like XLP, XLE, and USO are severely overbought, creating opportunities for cautious bears. The S&P 500 ended its week with a 2.77% decline, marking the end of the Santa Claus rally. Historically, when a Santa Claus rally does not occur, the average one-year return for the S&P 500 is 6.5%, compared to a 7.5% increase in years following a successful Santa Claus rally. Opportunities abound for bulls and bears, but market participants should not be too concerned about the lack of the Santa Claus rally over the past 7 trading days. 2024 was a year of resilience and recovery. From surging stock indices to growing household wealth, the numbers tell a story of optimism and opportunity. Looking ahead, next week, we'll talk about Wall Street's prediction for 2025 and how they might impact your portfolio. Thanks for tuning in to Money Mentor Brian. Don't forget to like, subscribe, and share for more insights. See you next time.